Assalamualaikum warahmatullahi wabarakatuh. My name is Hana Ratna Sakinah with number of student 18105 13012 and I will explain about a money. Definition of money. Money is a tool that accepted in use by general public as a payment or exchange in any economy, such as trading a good or services and repayment a debt. Money as a wealth is total valuable asset that can be used and convert into any transaction. To obtain money and wealth, it should be by a certain of income. To get a certain of income, someone has to do a work in certain of period of time. There are three functions of money. The first is as a medium of exchange. It make it easily buyer and seller to the transaction and avoiding a difficulties of barter, and also it's minimizing the time of a transaction. The second is as a unit of account. So money as a unit of account, it means that can be measured as unit of a calculation and determine the value of the goods or services that have varied size of wealth amount. And the third is as a store of value. So money as a store of value means that the ability of an asset, especially money, to have a value over a time. Because they have a value, so we can also use money not only this currently time, but also in a future. And then there are a payment system. The first is type of money. There are two types of money. The first is commodity money and a fiat money. A commodity money is a money that commodity or material of value is the same as the nominal of money. An example, in ancient time, people use gold, bronze, and silver as a payment of a transaction. So a gold is higher than a silver, and a silver is higher than bronze. And the second is fiat money. Fiat money is a money that is distributed by government in the form of banknotes. Like this today we use a money. There are also other types of payment system. The first is check. Check is a letter that issued by bank and can be used by a customer to make money withdraw orders from the banks. And the second is electronic payment. It's a payment system that internet facilitates as an intermediate means and doesn't involve paper payment form. Example of electronic payment can be easily found in this modern time, such as GoPay, Dana, and etc. And then there are credit and debit banks, electronic funds transfer, and stored value card. And then there are 5 characteristics of money. The first is money must be easily standardized. So money can easily ascertain its value. And the second is money must be widely accepted. It means that money can create efficiency. And then the third is money must be divisible. Divisible means that units of money can be divided into smaller units without losing their relative value. And then the fourth is must be easy to carry. So we can take the money everywhere. And the last is must be deteriorate quickly. In measuring money, the local central banks defines measurement of the money supply refers as a monetary policy or monetary aggregates. To avoid sustained episode of high inflation, a central bank must be concerned with money growth. The Federal Reserve System defines two different measures of money, that is M1 and M2. These measures are not equivalent and do not always move together, so they cannot be used interchangeably by policymakers. And then there are relationship money and inflation. Inflation occurs when there are a rise of a price of level in economic over a period of time. Increasing in the money supply, then the output growth will cause inflation. It's because the more of money chasing the number of goods, therefore the increase in monetary demands cause firms to put up the price. If the money supply increases at the same real output, the price will stay the same. The demand for money. the transaction demand for money. If the income higher, the demand for money is also higher. Because the quantity of money people hold for transaction purpose depends on their relation to nominal income, interest rate, and the availability of alternative means of payment. When the nominal income increase, like I said before, the demand for money is also increased. The lower of the interest rate, the demand is money of still higher because the income is higher. The less available alternative means of payment, the higher the demand of money. And then there are portfolio demand for money. The first is liquidity. When liquidity falls, the demand money increase. And the second is wealth. When wealth increase, the demand for money also increase. And then return relative to the alternatives. When return relative to alternative decrease, the demand for money is increased. And then there are expected future interest rates. When expected future interest rate increase, the demand for money is also increased. And the last is risk relative to alternative. When the risky of alternative increase, the demand for money is also increased.